Welcome to this Killik Explains Finance video. This week, quite a topical one. This is October 2018. We've seen recently a dip in the stock markets, both in America and the UK. That's the second one, fairly sizable one this year. So how do we manage what I'm calling stock market cycles? And that's the point about the stock market, is that you do get volatility. So this chart won't necessarily be fully visible out there, but don't worry, because there is a copy of it in the latest issue of Confidant. I'll reference that at the end, and you can ping me if you'd like to see copies of this chart and the other one that follows a few slides on. So don't worry if you can't see every piece of detail. The point that this chart is trying to make is that yes, over the long term, looking at say the S&P 500, that's the biggest stock market in the world, if you like, the most significant one, tends to drive what happens in the UK with the FTSE 100. If you were to look at stock markets, yes, they tend to rise, and sometimes they rise quite aggressively. But along the way, you get some pretty sizable dips, all right? And the way this graph has been prepared, some of the earlier ones don't look particularly sizable, but there have been big ones lasting various lengths of time, anywhere from sort of 14 months there, all the way through to more like 86 months if you were to take the 2000-2007. So what we're saying is basically if we look at this chart and we were to look at sizable dips in the equity market, so bear markets, the 20% fall or more, all right, and we look at the point at which they'd recovered from that dip, how long's it taken? And the answer is, in some cases, quite a long time. Now, the fact we've been in a huge sort of bull run on the S&P and the FTSE recently shouldn't lull you into a false sense of security. All that tells you is there may be another big dip coming, so how are we going to make sure we're positioned for it? Now, what we're not going to do, hopefully, and here's the problem, is basically what some people do. So it's tempting to panic. You know, people see the market falling, they think, right, crikey, sell everything, all right? Or try and be more scientific and say, I'm going to time this dip. Not easy. It requires two huge judgments, all right? You've got to be right or more right than everyone else in the market to get it right. So it requires a judgment of when to sell, and then you've got to have the courage to go back in again. And therefore, most people get it wrong and miss out. And what do they miss out on? Well, I've shown some data in other videos that demonstrates that if you miss out on the relatively small number of really cracking investing days that tend to follow a dip, you can seriously damage your long-term returns from the stock market. So it's a dangerous game, trying to time the market for all sorts of reasons, financially and psychologically. So a better plan is what? Now, some of this you'll have heard before, but I just want to go through point 2 on this slide in a bit more detail. This is point 1. So we need a 3-pronged methodical approach to investing. Number 1, let's get a rainy day fund in place. So let's have 3 to 6 months, typically of salary, depending on your job and the risks and so on, and the pattern of your employment income. Let's have 3 to 6 months set to one side as a rainy day fund. So that's going to pay for the leaking roof. That's going to stop us liquidating our long-term equity savings at the wrong moment. Let's also position, this is the point I want to make a bit more about this time around, and focus on this in a little bit more detail. Let's position a proportion of our total portfolio to meet foreseeable calls on capital. Stuff we know is coming, not tomorrow, in a few years. We need to get funds allocated and positioned accordingly. And then we can we can be confident leaving the rest in equities. And equities have demonstrated over time, the past is no guarantee of the future, their ability to beat inflation, which is all important over the long term. Over the short term, it can be quite a scary ride, but over the long term, they normally do the job. So we want to leave a decent proportion of our lifetime savings in equities, but we don't want to leave ourselves short when it comes to emergencies and predictable calls on capital. More about that second basket in a moment. Now, simple examples of what is a predictable call on capital. Well, it depends. This is a decision you might have made to send your kids to private school. I'm not saying you have to, but you might have made that decision. You know, as soon as a child is born, arguably conceived, when those fees will kick in. Normally, private school starts around 4 or 5, primary, secondary school around 11. So it's not like you have no idea when you'll have to pay the fees. And you can estimate the amount. Now, you won't get it bang on 11 years ahead, but better to have a go than to just leave it completely a chance, in my view. And as the payment date approaches, you'll need to allocate funds accordingly. So what we're suggesting here is, depending on when that bill comes in, so let's say you've made a decision you're going to pay the school fees up front on day 1, which you sometimes can do, and that actually reduces the total amount, for reasons I'll come back to in a moment, then as you approach that payment date, you want to be thinking about where the funds, the specific funds, not all of your funds, but where the specific funds to meet that call on capital are allocated. So, today is now. You have decided you're going to send your kid to private school, not straight away, primary school, you're going to wait till secondary school. So when they hit 11, you're going to pay a cheque to the bursar of that school that will cover school fees till they're 18. You can sometimes do that because the bursar will then go away and invest it, they get tax breaks and so on as charities, and that reduces the total amount you pay. You don't have to, you can pay as you go, but let's say you're going to do the lump sum approach. So, estimate the amount and then allocate funds. This isn't easy, I make it sound easy, but estimate the amount, allocate funds, i.e. your investments, in such a way you take account of the time to payment and the state of the market. So this does require judgment. I'm not saying it's easy, but it is worthwhile. So, key judgments to do what I've just written down on a couple of PowerPoint points there. Number one, the rate of inflation. You'll need to reach a judgment or look at what school fees are doing in terms of inflation. And I'm afraid the bad news is private school fees tend to run at a level that's way over the general level of inflation, close to double in recent years. The rate of portfolio growth. Now this requires a judgment. Okay, no one can tell you that for sure. You might need to model it on different assumptions, but what do you expect to get from the component of your portfolio that's allocated to the goal of paying those school fees? And where are we in the current stock market cycle? And this is the point, is that rate of growth is largely predictable if you're in something like fixed income securities and or cash, obviously less predictable when you're in equities. So the question then becomes, of the amount I think I'm going to need, where should it be allocated across those three broad baskets of stocks, bonds and cash? Now, this will look hideous. You may think, I can't read it, but do ping me at the end for a copy of the article if you haven't seen Confident, autumn 2018 already. So basically, if we were to look at the S&P 500's big bear markets, and the reason for choosing the S&P is actually they've had a big bear market lasted slightly longer than the FTSE, so let's be cautious. What we could deduce is that in a worst case scenario, using the past as our guide, I know that's dangerous, but using the past as our guide, okay, we could say, well, the longest bear market period as previously defined lasted around 8 years. So if we know we've got that school fees bill looming into view close to 8 years out, we need to think about where we're invested. Maybe we're not going to look at 100% equity investment at that point. Maybe we're looking at a mixture of bonds and or cash. The exact mix will depend on where you think we are in the cycle and your risk tolerance, if you like. If this all sounds a bit difficult, I'll quote Sir David Tweedy. It is better to be roughly right than absolutely wrong. So better to have a go, better to plan and be close, be there or thereabouts, than to just sort of abandon the project and just hope you've got the money when you need it. Now, what if you're dealing with multiple cash flows? It's all very well to say one school fees bill, 11 years out, yeah, I can plan for that. But life's more complicated than that. What about funding the retirement date? What about weddings you want to pay for your children, for example? What about the new cars? What about moving house or buying a second home? So clearly life is more complicated. So planning is vital. It's not difficult to project multiple cash flows once you've got the right spreadsheet. It's very difficult to do in your head. So you need to build a cash flow model. Now, some people know how to do that. Some people are good at Excel, but if you're not, it's not necessarily something you want to take on by yourself. And you need to review it, revise it, and repeat it, because life changes, circumstances change, people get divorced, they have kids, and so on. So it's important to make sure you don't just boilerplate it, set it down, say, right, we'll follow that from day one, because realistically, day 1 and day 200 may not look the same. Now, I've covered a lot of ground there. What I'm trying to suggest is that planning is the route to preventing you from having to move your entire wealth in and out of the stock market as some sort of horrendous market timing exercise. What we're trying to do is create those three buckets and focus on the middle one and how we deal with those foreseeable calls on capital. If you found the slides a bit difficult to read and you'd like to get a bit more detail on exactly where that 8.5 years came from that I mentioned earlier, then it's the autumn issue of Confident is a good place to start. And if you're not sure what you're looking for, ping me, editor@killik.com. If you'd like to watch other videos that go into some of the points I made here in a bit more detail, then it's killik.com/learn.